Welcome to Mortgage Markets and More. I am your host, as always, Peter D'Angelo. I hope you're doing well, and good evening to you on this Thanksgiving Eve. I wanted to drop the episode this week ahead of Thanksgiving to give you some useful information that could be good fodder at the Thanksgiving Day table. So there's been quite a bit going on, and there's some good news, actually, with today's episode. And we're going to explore a couple ideas, as well as our Did You Know section was actually inspired by a conversation I had with a client this week. And I said, you know what? This is good information to share. And so I will empower you with this by the end of the episode. But for now, we're going to kick things off, as we normally do, with our survey of mortgage interest rates as of recording this podcast on the Wednesday before its release in the evening time. 30-year fixed-rate mortgage is averaging 6.95%, down slightly from the 7.01 last week. The 15-year fixed-rate mortgage is averaging 6.37%. The 30-year jumbo is averaging 7.18%. The 30-year FHA is averaging 6.27%. And the 7/6 SOFR adjustable rate mortgage is averaging 6.94%. So we're seeing a little bit of relief across the board, and maybe it's flat, but relief is welcomed. Let's take a look at what the bond market is looking like, as this is setting the stage for what rates may be doing here after the holiday. The 10-year Treasury bond yield is at 4.242%, down a bit, actually, from last week. The 5-year Treasury is averaging 4.113%. The 2-year U.S. Treasury is 4.207%. So we've seen that the bond market is starting to subside a little bit. Those yields were tickling 4.5% on the 10-year. Now we're starting to see them come down. Why does that matter for us in mortgages? Mortgage rates are closely tied to the bond market, and now we're starting to see that come down a little bit. Let's talk about some of the reasons why the interest rates could be cooling a little bit as we're heading into the holiday. First and foremost, this past week, we're just going to go through a bunch of economic data that was delivered from last week on Friday till now. Even on Wednesday, it's been a jam-packed week ahead of the holiday. The Home Prices Case-Shiller Index, which surveys about 20 metropolitan cities in the country, showed 4.6% growth, and that's slightly below the 4.8% forecast. So it's a little bit cooler. The consumer confidence, this is a survey that gets conducted to get a sense of what consumers think about the economy and about the market at large. That came in at 111.7 versus the forecast of 111, so pretty much in line with expectation. Confidence is on the rise. It's doing pretty well. New home sales significantly missed. So new home sales came in with 610,000 units sold in October, which is well below the 725,000 units that were expected for the month. If we recall, when we looked at the National Association of Realtors last week, October was a busier month, but September was an extremely busy month. So maybe some misaligned expectations were there because of how busy September turned out to be. Jobless claims, as we look at every week, are continuing to subside. We're sitting at around 213,000 now. If you recall, a few weeks back, that was upwards of 250,000. And this $213,000 number, or 213,000 jobs number, is actually quite a bit less than what the expectation was. GDP. This is gross domestic product. This gives us an indication as to what the U.S. economy is looking like on the world stage, and that came in at 2.8% this week. It shows good growth. Expectations there are that we're going to end off with GDP at around 2.8%, indicating a strong economy. And when we look at our neighbors across the pond, the European Union cannot say the same. And if we look at the world stage and the GDP of other countries, the U.S. is certainly an outlier. So we have a strong economy on our hands here, which is a good thing. There's a reason why that may not be a good thing, and I will get into that in a moment. Manufacturing activity is a bit below the expectation. We look at manufacturing because it's another part of the puzzle of what the economy is doing. So how that's going influences the traders on Wall Street and people who are investing in the bond market and the mortgage-backed security market and all of the things that set the stage for what it feels like for you and what type of interest rates you're going to have on your cars, on your mortgage, on any type of lending. Inflation. I held off to produce today's episode so that I could have the personal consumption expenditure report, which was delivered at 10 o'clock this morning, because I was awaiting it with bated breath. I was interested to see. I saw the bond market this morning because I am a nerd, and on my iPhone, when I go to bed at night and it sits on its cradle, I don't have photos that scroll through. I have the 10-year Treasury yield. And then I have a little widget that tells me what the 10-year Treasury yield is doing at all times on my home screen, and I saw it came down a bit. So I was wondering if maybe people know something I don't know, and I figured let's just wait. Let's see what the personal consumption expenditure comes in at, and here we are. We have flat month over month. Came in at 0.2% increase month over month, and this is, again, the PCE. This is the Fed's preferred inflation gauge. So it came in 0.2% up month over month and 2.3% up year over year. So we haven't made any further progress toward 2%, which is the Fed's goal and their target. However, I think we should celebrate that it hasn't gone up. So that is certainly something to celebrate and be thankful for right now. The core PCE, and again, that's the personal consumption expenditure and looking at the cost of things excluding the volatile elements, things like food and energy. The core came in at 0.3% increase month over month and at 2.8% up year over year, which did match expectations. However, last month, the core was at 2.7%, so it came in a little bit hotter. We talked a few weeks back about the PPI, the producer price index, and we saw that actually surprised us to the upside and was a little bit higher than we were expecting. And I had mentioned that could set the stage for maybe some higher inflation because the producer prices translate to higher consumer prices. Well, at least at first reading right now, it hasn't had that much of an impact. I'm eagerly awaiting to see what November's report looks like when we get that in December. Pending home sales is the last piece of data I wanted to provide you with today, and that came in slightly better than expectation. That was 2% up month over month after they were forecasting 1.8% increase in pending home sales. Now, going back to September, it was 7.4%. So quite a big drop off month over month. However, when we compare year over year, we're looking better, and also month over month is to be expected a little bit cooler because of the seasonality of our industry in real estate. When the holidays start coming around, people take their eye off of home shopping and they focus on the time with their family, as is appropriate. But that also means that there's just less activity. So pending home sales are down a little bit. Overall, there's a bunch of mixed data points here. This is, I would call it mostly good news overall, but I'm going to go back now to that part I promised I would mention. The Fed is meeting in December, and we are waiting to see what they're going to do. They already cut the interest rate twice. They did a 0.5% cut and then a 0.25% cut. And then we did get the Federal Open Market Committee minutes, which give us some insight as to what the conversations were like at the Federal Reserve's meeting ahead of their announcement. And quite frankly, what those minutes showed was nothing to surprise us, except for the fact that the conversations are still developing about another rate cut in December. As far as the markets, I talk about this all of the time. Interest rates and how interest rates are for mortgages right now are heavily dependent on what expectations are. The market, based on how it's trading, is expecting around a 60% probability of a Fed rate cut in December. Now, we talk about how well GDP is doing, especially compared to the world stage, and we also see that inflation is remaining flat. With inflation remaining flat and an economy that's doing very well comparatively, and I mean 2.8% growth is nothing to shake a stick at. That's good growth in our GDP number. What case? Oh, I forgot to mention, and the initial jobless claims. people are still holding their jobs. There's not a flood of more people going into unemployment. So job market's looking good. GDP's doing relatively well. Inflation's remaining pretty stagnant right now over the past couple months. Let me ask you this question. What case does the Fed have to cut rates? If I'm looking at all of this, I'm of the opinion that I don't know that there is one. I hope for interest rate relief for particularly the first-time home buyers who are really slogging it out there. But I don't want to forsake the other end of the spectrum too. I know of many families that I work with that would love to be able to downsize and move or sell their home and make a lateral move. And it's just, to them, it's cost prohibitive right now. We've gone through the numbers. It's not as bad as it looks when you get the sticker shock of trading in your 3 or 3.5% interest rate for, let's say, a 7 or 6.5% rate. But any increase in spending for your house is to be considered as something that could be very prohibitive in making that decision, especially when, look, inflation's running at 2.3%, like we were talking about. That's price increases. So that's on top of the high prices that we had a year ago and months ago. So right now, we're going to see what retail sales look like, and that'll give us a really good idea because the retail sales is going to tell us how much the American consumer is spending. And thus far, based on the survey that we talked about a couple episodes ago when we looked at the credit card usage and balance growth, people are pulling in the purse strings ahead of the holidays. Black Friday and the other sales that are going to be happening this week are going to be telling. But for right now, to bring it back to the Fed, I don't know that there's really a very good case. So what does that mean for you? With a 60% probability being priced into the market of the Fed's cutting the interest rate, if they don't, prepare for volatility. Because if they don't cut their interest rate in December, you're going to wind up probably seeing, or it's possible that we could see an increase in interest rates. Arm yourselves with the knowledge, plan accordingly. That's really the main point of that. I'm looking forward to keeping our eye on the ball here and keeping you posted on those updates. That being said, my exploratory idea today was I wanted to talk real quick about why the wintertime is a good time to buy. Now, I know that we all have family obligations. Preparing for the holidays gets super hectic. Holiday parties, obligations left and right. However, if you are interested in purchasing and you're in a position to purchase, you've gotten pre-approved, the wintertime could be a really good time to buy. People list their homes in the wintertime because they need to list their homes in the wintertime. A lot of people have the mentality of, I'm going to wait till the new year. I'm going to wait till I get through the holidays. Some people just like to keep the home that they're in for the holidays. I'm going to wait till afterward. But for the opportunities, for the right opportunity, the wintertime could be a really great time to buy. Sellers have a little bit more motivation than they do throughout the rest of the year, as evidenced by their timing of listing their home for sale in the wintertime among the holidays. Secondly, your competition is going to be a little bit thinner because, like I mentioned, a lot of people have their obligations for holiday parties and family obligations, so there's going to possibly be less foot traffic going through those open houses, less people placing those bids and placing those offers that you're going to have to compete with in the competitive environment. Thirdly, there could be cost savings. Price points could come down a little bit in the wintertime because there's less activity, less competition, maybe a better price. So for those of you who have gotten pre-approved and thought, we're just going to chill out until the new year, keep your radar up. You never know. There could be a good opportunity waiting around the corner, and I can't think of a better thing to unwrap than taking those keys and putting them into the door of your new home. So bear that in mind. For today's Did You Know section, we're going to get into ways that you can actually manage the higher interest rate environment. I had a call with a couple great clients this past week, and they actually brought up this question. They asked me if myself and my company here at Rate offers temporary buydowns, 2-1 buydowns, 3-1 buydowns. And for us to go into discussion about this, I want to make sure that I make clear what buydowns are. So we've talked in the past about discount points. That's when you pay a premium upfront and it gives you a lower interest rate. And if you don't pay that premium, your interest rate is higher for your 30-year mortgage. We'll just discuss 30-year mortgages. So temporary buydowns operate a lot like the way it sounds. They are temporary relief for your mortgage payment and your interest rate that can be provided by way of a seller concession. How temporary buydowns work? It's part of the negotiation process where you're going to be placing an offer and you're going to say to the seller, all right, I'm placing my offer at $500,000 and we're putting 20% down, say, and I would like to ask you for, say, a $10,000 seller concession. That $10,000 seller concession gets used to create a subsidy, and that subsidy is held in an escrow account, which gets managed by your mortgage servicer after you close and affords you a lower monthly payment for a prescribed amount of time. And I know talking generally, it's a little difficult, so let's dive into a real-world example, and we're going to talk actual numbers so that you can see what a temporary buydown can get you. I mentioned a $500,000 purchase price, so that's what we're going to use for our example. $500,000 purchase price with 20% down, which is $100,000. Now you're looking at a loan amount of $400,000. Let's say your interest rate is the average that we discussed today, 6.95%. That $400,000 loan is costing you $2,647 per month. I'll leave the change out of it. First, you can explore a 1 buydown, a 1-0 buydown. This will let you will have your mortgage note and your interest rate will be 6.95%. However, for your first year of repayment of that mortgage, the effective interest rate of repayment is going to be 5.95%. That 5.95% would now have a monthly payment of $2,385 a month. So you can see that is almost $300 less, and that's savings for your first month. Well, that difference, that $300, that's what the subsidy is used to defray. So instead of making your full monthly payment at the $2,647, you're making that payment at $2,385, and the difference is actually paid for by that concession that you negotiated when you purchased the home, and that satisfies the full payment of the mortgage. So out of pocket, you're not paying the full amount, and you have some temporary relief. There are many iterations. I'm just going to go through the 3 main ones. There's the 1-0 buydown, the 2-1 buy, and then there's a 3-2-1 buydown. All of these will then have increased amounts of the subsidy that's required. So now let's look at a 2-1 buydown scenario. Your first year, as you guessed it, your interest rate would be 4.95%, and your monthly payment would be $2,135. That's significant savings. Then your second year, you'd step up to the 5.95%. Then in the third year, your interest rate would be the 6.95%, and that monthly payment that you saw on all of your mortgage paperwork when you closed on your home. Then the 3-2-1 buydown is the even more extreme and gives you a little bit the most relief for the longer period of time. You get to see an interest rate of 3.95% in your first year, which translates to a monthly payment of $1,898 a month. And then it steps up to 4.95%, 5.95%, and then in the fourth year, that's when your mortgage steps back up to the 6.95%. As you can see, with each one of these, if you're going to have more savings throughout more time, you're going to need to request a higher concession from the seller. So in the 3-2-1 buydown scenario, you would need to be negotiating a seller concession for $18,297. That $18,297 is what's affording you the ability to make those lower payments for those 3 years. Another fringe benefit of these buydowns is, let's say interest rates do go down in 2 years and they're at a level that make a lot of sense for you to refinance. Well, the money that was put aside in that subsidy for your temporary buydown is available to you at closing to help defray your closing costs on your refinance and or half dozen one way or the other this way can lower your payoff amount. So let's say your mortgage balance after 2 years is $396,000. It's probably going to be somewhere in that range. You don't pay a lot of principal off early in your mortgage. So you'll have that subsidy and it will be reduced by whatever balance is left in that subsidy that your current mortgage servicer's been holding for you to support this temporary buy down. That being said, if you use that same money for permanent buy downs, you don't get that money back. So if you buy down your interest rate now when you purchase, and let's say you're able to get 6%. Right now, average is 6.95%, but let's say you buy down your interest rate to 6%, you have a lower payment that is not going to change, and that's great. But let's say interest rates drop significantly in a couple years, and you go to refinance, you're just going to be refinancing, and there's not going to be anything else left over. Those discount points you paid or that you negotiated the seller to give you a concession in order to pay, that money is gone, bought and paid for the contract that was your mortgage for 30 years when you originally purchased the home. So there's a plus and minus. Things to bear in mind with all of these numbers that I mentioned. Number one, these numbers are just principal and interest payments. These are not payments that indicate a fully amortizing mortgage with taxes and insurance included. So if there's homeowners insurance and taxes, that's an addition. I wanted to keep it with the principal and interest. Secondly, temporary buy downs are great. However, you need to make sure you're comfortable with what that end payment is, because there may have been people 2 years ago that leveraged a 2-1 buy down thinking that, well, by 2024, I'll be able to get a lower interest rate and refinance. And right now, that may not be the case. So now they have to manage that higher monthly payment. So if you are interested in temporary buy downs, make sure you're comfortable with what that end payment is going to be in the event that you don't have the opportunity to refinance. And then thirdly, take into account everything. Take into account what it would be like. Do a comparative analysis of, well, if I'm getting a $10,000 concession from the seller, would it make more sense to have temporary relief for you and for your family and for your financial goals? Or would it make more sense to have the peace of mind of knowing that you have a fixed rate mortgage that is already discounted using that money, and you don't need to necessarily bank on if and when there will be a refinance opportunity in the future? That is it for me today. I hope you found this helpful and useful, and throw around some of this knowledge at the Thanksgiving Day table. I know we'll stay away from politics, so here's some cool data, some updates for you on news, economic data. Tried to stack this episode with the intent of getting you empowered to flex that knowledge muscle at the Thanksgiving Day table. But in the meantime, I am grateful for you. Thank you so much for listening. I appreciate your time. If there's anything that you'd like me to explore, or if you have questions, please reach out to me at peter.d'angelo@rate.com. My email's in the episode description. I am wishing you and all of your families a very happy Thanksgiving, and I look forward to catching up with you all next week after the holiday weekend. Take good care.